Hey guys, Akil Stokes here. Welcome back to another episode of the Trading Coach Podcast. Today we're going to talk about two things: the difference between investing and trading, and how to determine which time frame is the best fit for you. Now, this is another video episode, so make sure you check it out on Spotify or YouTube for the video versions. I'm going to show some cool charts that make what I'm saying a lot easier to digest. And Apple Podcast people, I believe video episodes are coming to you guys shortly. Fingers crossed that it happens soon, if not already. So today's episode comes from, it comes from a feed from one of my favorite traders, Brian Shannon, who I'll talk about in a little bit. But the original topic comes from a conversation I was having with one of our traders over at tier1trading.com. And the conversation was basically about, is trading worth it? The difference between just passively investing or investing in general versus trading, and the time commitment. And it was a back and forth between a few of us on the platform. And pretty much, to sum up the part I want to focus on today, is you can certainly do both. You don't have to think that being an investor and being a trader is somehow a conflict in interest, meaning like you have to do one or the other. They are completely different investment paths, and because they're so different, you can certainly do both. And as someone who typically advised, although I'm not here giving financial advice of any sort, legal disclaimer, if I were to advise on a path to take, I would certainly advise, but not advise, doing both. Having your active trading, if that is something that you're interested in, but also having your more passive or longer term investments on the outside. So I just want to make that clear first and foremost. Now, the feed from Brian Shannon was titled How to Choose the Right Time Frame for You, and I'll put the link to that below. But real quick, because if I'm going to take someone's stuff and mention it in the Trading Coach Podcast, I want to give them some love. I'm a big fan of Brian Shannon. I have two Brian Shannon books somewhere. One is underneath here, and the other one, you guys can't hear me, is here. So one I bought a long time ago, hopefully you can see this, is called Technical Analysis Using Multiple Time Frames. Look at that, multiple time frames, same as this kind of topic. Really good book with a funky cover, which I personally enjoyed. And then the one I bought recently, and by recently I mean a couple years ago, I believe, was Anchored VWAP. So Maximum Trading Gains with Anchored VWAP. Now, this isn't something that I personally use in my trading. I have a podcast coming out soon about different kind of fad trading styles and techniques out there in the market, and this might be one that you've heard of, but this was something that I read during one of my continued education periods, meaning that each winter I dedicate some time to continued education. Sometimes it's strategy development, sometimes it's taking a training course, sometimes it's diving into a new book, and this happened to be it. So two good books by Brian Shannon. I do recommend both of them. I will put you here for next time. So let's talk about this feed real quick. I'm going to read parts of it for you, but not the whole thing. But he says that most arguments on Twitter come down to participants having different time frames. I'm going to interrupt right away, which will be a common theme in this podcast. So we had a conversation in my live trading room this morning about how two traders can both be right despite taking different actions. And as traders, I think that is something that we need to accept. Unfortunately, many of us think that we all have to agree and it's me versus you. If I have one opinion, I am right. If you have a different opinion, you are wrong. And there's no way we can both be right. So we have to fight about it in the angry words of Twitter, right? But the truth is both traders can be wrong. Both traders can be right. There's many different reasons for this, but let's just take the time frame example. Let's say me and you are both looking at the euro dollar, and I am looking to get bullish and you're looking to get bearish, and we both type up a Twitter thing and we yell at each other for it. Understand that our perspective is going to be a big role in that decision making. Not just our perspective on whether we are trend continuation traders or counter trend traders, because that's going to give us separate views in the first place, but also our literal perspective of the chart. I can easily be looking to get, long on a 5-minute chart. You can easily be looking to get short on a hourly chart. And the hourly chart and the 5-minute chart could be given completely different signals, right? So what we see in the market, right? Trade What You See, another great book by Larry Pesavento, somewhere in this library of mine. I love that title and I love that kind of mantra for trading in general because it really is about what we see personally as traders and the understanding that not everyone is looking at the markets the same way. So he says most arguments come down to participants having different time frames. Time frame choice is vital. Your rules of engagement are largely a downstream effect of your time frame, which you choose based on your risk tolerance and reaction time. Many factors contribute to success or failure in the markets, but one of the most important is to know your personal strengths and weaknesses. Only then can you figure out how and when to leverage them. So we'll talk a little later about the difference between investors and traders. If I happen to remember, I probably should write this down somewhere, but I won't. But let's kind of start by looking at a really broad scope of different type of trading terminologies that you'll hear out there as far as like time frames or type of trader and what they actually look like on the price chart. So we'll start with investor, right? And there should be a nice little chart in front of you right now, right? The investor, their main time frame may be the monthly. Their trend focus is going to be longer term, and their typical trend duration, meaning let's just look at that as like time in trade perhaps, is going to be several quarters, right? So several 3-month periods, every 3 months is a quarter, to several years. The position trader, right, their main time frame is going to be weekly. They're looking at more intermediate trends, right? And their direction, or their duration, I should say, is going to be up to 6 months, so like a half a year. The swing trader, their main time frame is the daily. Their trend focus is short term, right? Some of you guys are like, daily, how is that short term? Oh my gosh, right? But short term relative to someone holding things for years. And they're typically looking to be in a trade for a few days, a few weeks, but certainly less than a few months in the most case. And then you have the day trader where their main time frame is the 30-minute. They're looking at the micro trend, the small trend, and their duration is in a trade is going to be intraday. Now, we can break up these categories even more. I like to throw something in between called the, now I forgot the word, the intraday trader, excuse me. That's, for me, is going to be more like hourly 30-minute. So that would replace the day trader on your chart. And for me, I would have the day trader a little bit lower, kind of 30-minute and down to the 5, right? That intermediate trader is kind of like hourly chart type of guy or girl. Swing trader is like 4-hour daily chart type of guy, type of girl. But the point is, these are the general types of trader that you see out there. So this is something you need to consider when you're thinking about what type of trader you want to be and what type of duration you want to hold your trades for. Now, I know. The question that comes to mind, we get it all the time. Akil, what is the best time frame to trade for beginners? And I have an answer, but understand there isn't an answer. So first and foremost, you need to match what fits up with your lifestyle, not just your personality and like, are you on edge and do you need to be trading every living second? Or are you more laid back, someone that likes to take their time, really look back at the markets and dot your I's and cross your T's before doing stuff? That's going to play a role. But also your lifestyle. I always say this, right? If you don't have a set period of time available to actively look at the charts as a day trader, it's probably going to be very hard to be a day trader. If you are someone that has a job, but you have natural breaks in your job or you're in front of a computer and you can kind of peek at the charts every once in a while, well, you can probably get away being an intraday trader or a swing trader because all you have to do is look at the charts maybe every hour or every few hours. If you're someone that is booked throughout the entire day, I've worked with traders who have been truck drivers before, and they're like, look, I'm driving the whole day and I probably shouldn't be on my phone while I'm in my truck because they have cameras and they see everything I do and I'll get fired. Well, they implement more of a longer term trading strategy where maybe they just look at the daily chart and they look at a once a day setup at the end of the day. So that style or that matters first and foremost when deciding what type of trader you want to be. But if you made me choose, if you threatened me and said, Akil, I absolutely need an answer, and if you don't give me one, I will harm you, I would say that typically as a newer trader, you probably want to go away from day trading and towards swing trading, I would say. Swing trading to maybe end of day trading. And the reason I say end of day trading or avoid day trading, excuse me, is just mainly because of the speed. So I always tell you guys this, right? When it comes to risk management, When we first start trading, when we're brand new, straight out the diaper, after we've done all the stuff that you're supposed to do before you should ever be trading live, of course, we want to risk as little as possible. Because when we are thrown into the live market environment for the first time, we are likely to make the most mistakes, right? Think about a kid learning to ride a bike, right? When you first ride a bike, my kid had helmets and elbow pads and knee pads on because although he technically knew how to ride a bike, he was a little wobbly, and every once in a while he'd forget how to do something and boom, crash and bust his head open, right? So you're most likely to make your biggest mistakes and your most mistakes when you are brand new. Then as you get more practice, as you get more experience, as you hopefully learn from your mistakes through journaling, that evil thing we always tell you to do but no one wants to do, but you should do it, you become better and better, and hopefully you make less and less mistakes. So it only makes sense to risk less when you're making the most mistakes and risk more when you're making the least mistakes. The same thing goes for speed in the market. Day trading is fast. I will tell you what, the speed of looking at you think 5 minutes is a lot of time when you're doing absolutely nothing. I'll tell you what, 5 minutes when you're looking at 4, 8, 10 charts, it goes like this. Boom. Thanos snap. Everything disappears. That's your profit if you're a new trader making mistakes, right? And think about all you have to do within that 5 minute period. You have to go through your process of analyzing the charts. You have to maybe go down to a lower time frame. You have to measure out your entry stops and targets. You have to look at your risk management. You have to remind yourself of your entry reason. You have to set up your position size, right? There's lots of things you have to do on any individual trade. Now multiply that by 2, 3, 4, 5, 6, however many pairs or assets you're watching. That's a lot to do. And what typically happens is traders turn into this. Ready for it? La da 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 da. Nothing's happening in the market. Right? Brain explode on keyboard, and now you gotta clean it up or hire someone to clean it up because you probably can't clean it up because your brain exploded, and your brain is what makes everything move. But that happens. You get overwhelmed or you get paralysis by analysis, which my visual representation of that looks like this. Da-da-da, looking at the trade. Oh my gosh, what do I do with it? Right? Or you freeze up and do nothing. No brain explosion, but just as bad. The point is, there is a lot going on. It is very intense. It is very stressful. And you're dealing with this intense, fast-paced, stressful environment when you are brand new to riding your trading bike and you're already freaking out because there's live money at risk and you don't know how to handle it. So as a newer trader, when you're trading on a higher time frame, a 4-hour chart, for example, and you're looking at your clock right now, it's like, okay, it's 3 o'clock, the candle doesn't close till 5 o'clock. You have 2 hours to kind of look at that. Look at that. Oh, that looks good. Let me dive into that some. All right, well, what's my entry? Let me whip open my trading plan. All right, it says to do this. All right, risk reward, okay, position size, all right. You have lots of time to kind of double check. I have traders on the platform that even check in with me. They're like, hey, Akil, got this double top on the 4-hour. Got about 2 hours before it forms. Just looking for some confirmation that this is a double top you see as well. And I'm like, yeah. Okay, let's go. So I would recommend that to the newer trader. Now there are cons to the higher time frames as well, right? Although it is slower and you have more time to think is sometimes a bad thing. You get that FOMO where you had a signal and it's at the perfect entry and now it's moving without you and you still have 2 hours left to take it, but now you see your profit getting sucked dry and you get more tempted to do things you shouldn't do, or you overanalyze the market to the point where you convince yourself that maybe you didn't see the thing that you initially saw. Or here's one I get a lot. A lot of traders are scared to hold positions overnight or over the weekend. Well, guess what? If you are a swing trader holding trades for hours to days, there's a good chance at some point you are going to hold a trade overnight, if not over the weekend, and you have to deal with that uncertainty. So it's not all rainbows and unicorns and nicely colored butterflies. There are downsides to the swing trading timeframes as well. Now, going back to the feed that Brian wrote, I want to focus on this paragraph I really like. The title is "Finding the Right Time Frame for You Requires Experimentation." He says, as you experiment, you'll likely make a lot of mistakes as you try to figure out what resonates best with you. So be sure to trade smaller during this learning period. Look at that. I just said that, right? Look at that. Thinking just I haven't read this before. I saw the feed, but I haven't read this. You guys know I do the podcast cold turkey, so I'm literally reading this for the first time. He says, to help figure out your time frame, ask questions like this. 1, are you a fast or a slow thinker? Meaning, can you quickly observe and objectively make decisions, or do you get panicked when you must act on shorter time frames? Another one says, how many ideas do you want to generate? Can you come up with a constant stream of tradable ideas, or do you prefer to be more selective with your ideas, waiting for things to align? And this is kind of the whole quality over quantity, where if you want that action, right? Day trading is for you because you're going to get that action. You're going to be a wild gun-slinging cowboy, pew, 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 right? You know the deal by now. That's been our ongoing joke here on the podcast. If you guys are new and just think I'm some sort of crazy weirdo, I'm not. I like repeating things on podcasts. If you're someone that needs more time, you're really focused on, hey, I don't want to have a lot of ideas, but I want high quality ideas. Maybe higher time frames are for you. What's interesting that I see with lots of traders, including myself, is that so when you're a newer trader, you tend to want more trades because we come into trading with this idea that traders have to trade. I want to trade all the time. It's fun. It's new. It's exciting. I want the action. But then as we progress in our trading journey, we tend to flock to higher time frames and trade less. And there's 2 reasons for this. One reason is we understand that a quality trade is better than just a lot of quantity of trades, meaning that in the beginning, we tend to fall victim to the time for money myth, meaning that the more time I'm doing stuff, the more action that I'm taking, the more money that I will make. So the more we do, the more money we'll make, because that's how it works in our normal 9-to-5 jobs, right? If I work more hours at my job, my paycheck is bigger, therefore I just have to do more to make more. However, trading is a little bit different, and you can actually make the same, if not more, by doing less, especially if that less comes with a higher quality opportunity. Because although you may be doing more on a lower time frame, if you're doing more of the wrong thing, making mistakes, then you're going to lose more money. So it actually has the opposite effect. So you see a lot of traders flock to the higher time frames as they get more experienced, and they get really, really good at identifying their grade A trading opportunity. Another reason is just quality of life, right? When I was day trading, it just took up a lot of time. The reason I got into trading was for 2 reasons. Freedom of money was the first one, and then freedom of time was the second one. And as I day traded, I realized that I was a slave to my computer. I was investing 3-4 hours a day between actually day trading and day trading prep. And I'm like, man, I could be using those 3-4 hours for other things like hitting the gym and getting swole, right? I haven't been in the gym lately, but I just did some push-ups because I'm starting my summer season right now. So by eliminating day trading and being able to make the same as I was off of swing trading, I am making the same trading salary, I guess you can say, but I'm doing it with less time, which is my ultimate goal. So there's that as well. That actually goes into Brian's next point, where he says, how much time do you have to commit into the markets? And then following up on that follow-up, the next part of his paragraph says, your time frame isn't a marriage, it's a decision. And I think this is important to understand, whether it's your time frame, whether it's your strategy, whether it's your market, right? I work with a lot of traders who started in Forex and now they're trading futures and they're trading commodities and other things, right? Just because you make a decision now doesn't mean you have to stick with that decision forever. You can easily start as a day trader and become a swing trader and then go from a swing trader to an investor. You can easily become an investor. I started in the stock market as an investor and then go down to be a swing trader and then go down to be a day trader, right? You're going to evolve as a trader, both professionally and personally, and it's only right that your trading style, whether it's the time frame or the type of trading strategy that you follow, it's only right that that evolves as well. So that's perfectly fine. You don't have to make a decision today and lock yourself in for the rest of your life to it. You can adjust. Now, going back to investing things, I said I was going to talk about this before. I just want to kind of separate the difference between long-term investors and short-term traders with another nice chart that Brian shared. We'll start with the first category, overall strategy. And it says long-term investors participates in trends that can last for years using longer-term market exposure to absorb short-term volatility and patiently compound returns into long-term wealth. So long-term investors, if you're looking at your charts or your P&L every day, you've got a problem, right? You should be looking for future value. You're getting in something not for now, but something years later. So don't drive yourself crazy by looking at it every day. You're going to have ebbs and flows in the market. I tell this to all people who get involved in investing. I said, hey, don't worry. What if the market crashes, Akil? Don't worry about the crash, right? Do you plan on cashing out tomorrow? No, right? So just absorb it, buy more when it happens. And then 10 years from now, when it makes up for that initial crash and has another crash and it makes up for that next one, you're going to be in a much greater position. And something that I tell these investors all the time is like, I want you to look at a chart of, let's say, the S&P, for example, or any individual stock. Look at it now, and I want you to look at it back 10 years ago. And I want you to look at it back 10 years ago from there, right? And what do you notice? Yeah, it went up. So don't dilly-dally, don't panic, get involved now, and then you're going to thank yourself down the road. Now, on the other side of things, as far as overall strategy, short-term traders, they enter a stock as soon as the short-term trend confirms a longer-term trend, exploiting volatile periods to leverage time for quicker, consistent trading profits while limiting drawdowns. So I always say that being a trader is like a mercenary, right? I don't really have a long-term bias in anything that I trade. Sometimes, I should say this, sometimes I do, and that offers some really cool trading opportunities, but I don't need a longer-term bias. Like, so if I am buying Apple, I don't really care what Apple is going to do 10 years from now, right? What I want to look for is short-term volatility. What has Apple done now? What key level did it break? Where do I think it's going to go now that it broke that level? And how can I selfishly get involved from that break to that next level and then get out before I get bit? And then do it again the next day. So it's weird because it's selfish, but that is the mindset. Next is going to be risk tolerance. For the long-term trader, must be able to sit through larger account drawdowns during short-term volatility, but lower risk of emotional decisions. So this goes hand in hand with what I said before. You're going to go through ebbs and flows, and you got to sit through them. You got to not panic. Again, just hit that X button and don't look at it. But the fact that you're not looking at it allows you to avoid those emotional decisions. Because trust me, there is nothing more emotionally violent than watching yourself in the position and watching your money kind of drain from that position. It is bad. And it typically causes traders and investors to make multiple mistakes. Either they try to avoid their stopping point by moving that stop loss down and ultimately losing more, or they bail on the trade because they can't take the pain and they tap out. Now, from the trader side of things, that often little tolerance for larger account drawdowns, but must accept heightened risk of emotional decisions due to the faster market cycles on shortened time frames. Reaction time, I don't think we need to spend too much time on this, but investors, they can make slower decisions. They have more information. They have more time to do it. Traders, quicker decisions. They have to be more unemotional in them as well. Time commitment, long-term investor, little to no time. It depends on what style you're taking. If you are a passive investor, maybe you're dollar cost averaging into an index, it takes really zero time. You can automate it, right? Where it just grabs your money out of your account every week, bi-weekly, month, and puts it in there for you. So maybe a little bit of time to set that up in the beginning, but nothing else aside from that. On the other hand, if you're more of an active passive investor, it is going to take a little bit more of a time commitment on the top, just kind of do your research and generate your idea. But once that's done, then you enter your play, and then you probably don't have to do nothing for a very long time. Active trading, well, that's more of a day-to-day commitment. You have to have a routine of you're doing your top-down analysis, you're setting up your trading day, you have your times where you're actively watching the market or you're taking a peek at the market, right? So there is a lot more, not that it has to be a lot, but there's a lot more time commitment there versus the investor. Decision-making style, right? It says long-term investors have a more passive style, fewer buy or sell decisions, which reduce the risk of emotional decisions, right? You trade less, you make less trading mistakes. Time versus money myth. Traders, more proactive, more buying and selling decisions, increase risk of emotional craziness, and execution mistakes. And then the final one is the typical holding period, which we kind of spoke about already. Now, with all that being said, I want you guys to participate. I'm going to create a poll question right now, so it's already live by the time you see this. But I'm curious, what type of trader/investor are you, or trader/investor do you aspire to be? Meaning, and I'll sort out the questions later so you can see it, but do you invest only? Do you trade only? Do you trade and invest, right? Where do you see yourself on that spectrum, or where are you currently on that spectrum? If you can answer that question, it's under the YouTube community tab. that will be lovely. I've been getting lots of responses from you guys, how you love the community tab, you love the poll questions because it gives you a greater sense of not being alone and that other people actually think the same way you do and you're not as crazy as you think you are, which is a good thing. So participate, hit that like button, subscribe if you're new, that way you don't miss the next video. And until next time, plan your trade, trade your plan. Oh yeah, 3-day online workshop, March 17th to 19th, limited seats, register now, don't miss out. Yeah, see you there.